Imagine having a crystal ball that, instantly cuts through the most complex financial reports, pinpointing the biggest risks shaping our world right now.
That'd certainly be useful.
Well, that's pretty much our mission today. We're taking a deep dive into the latest global financial stability report from the IMF.
Yep, turning that dense analysis into something clear and vital for you.
Our focus today is on this significant increase in global financial stability risks as of April 2025.
And it seems largely driven by these escalating trade tensions and, well, just general economic uncertainty.
Exactly. We'll be drawing key insights directly from that IMF report. The data runs through mid-April this year, and we'll add some crucial context too.
The goal really is to cut through the noise, right? Deliver the essential nuggets.
That's it. We'll uncover why global growth might be at a shockingly low risk level, where these financial fragilities are really building up.
And what it all means for you, whether you're managing investments, maybe prepping for a meeting, or just curious about the global economy.
Think of this deep dive as your shortcut to being truly well-informed. Okay, so let's unpack this. It helps us step back just a bit first.
Good idea. Where should we start?
Well, we actually started seeing some significant warning signs way back in October 2024.
Ah, right. The previous report.
Yeah, the Global Financial Stability Report highlighted what they called stretched asset valuations, particularly in tech stocks.
And interestingly, pretty low market volatility back then, despite all the economic uncertainty that was already swirling around.
Right. It felt a bit disconnected. Leverage was clearly growing, too, especially among these non-bank financial intermediaries, NBFIs.
And banks were getting more exposed to them.
Definitely. These were essentially fragilities just sitting there waiting for some kind of adverse shock to amplify them.
And here's where it really took a dramatic turn.
Yeah.
Everything shifted starting in February 2025.
What happened then?
The U.S. began rolling out new tariffs. That immediately triggered a noticeable bout of policy uncertainty. Then, boom, April 2nd, surprise tariffs announced on almost all U.S. trading partners. That really escalated things.
In the financial markets, I imagine they didn't take that quietly.
Not at all. Swift and dramatic reaction. We saw stock markets become highly volatile. Core sovereign bond market yields started gyrating wildly. Emerging market currencies began depreciating.
Corporate bond spreads
Widened significantly. The report itself actually calls this spike in volatility a crucial catch-up.
Oh, catch-up? To what?
To the previously elevated economic and trade uncertainty that markets had, maybe surprisingly, seemed to ignore for a while.
Right. And I guess that volatility stuck around.
It did. Remained stubbornly high as retaliatory tariffs kicked in, particularly between the U.S. and China.
So what does this all mean for the bigger picture, the growth outlook?
Well, the IMF's growth at risk model, the GAR model, it basically quantifies these downside economic scenarios.
And what's it showing now?
It's forecasting a significant increase in these risks. In the year ahead, there's now a 5% chance global growth could fall below 0.4%.
0.4%. Wow. How does that compare?
Well, put it this way. That's nearly a full percentage point worse than the October 2024 assessment, which was 1.2%.
That's a huge jump in risk.
It really is. The core insight here is that what maybe felt like a remote tail risk, near stagnant global growth, it's now a much more tangible threat.
Something investors and policymakers really have to prepare for now.
Absolutely. It's front and center.
That's a truly sobering outlook. Let's delve into the three core vulnerabilities that are primarily driving this risk increase. They seem crucial to understand.
Okay. Where do you want to start?
First up, the persistent risk of further asset price corrections. Because you see, despite all this recent market turmoil, valuations are still stubbornly high in some key areas.
Right, even with the dimmer global economic outlook, like equities and corporate bonds.
Exactly. Take the U.S. stock market. It's still trading around the 80th historical percentile of forward price to earnings ratio since 1990.
That's still quite elevated.
It is. So if you're managing a portfolio, you have to ask, are these valuations driven by fundamentals? Or maybe by market exuberance, especially if earnings growth isn't guaranteed.
And another critical piece here is the equity risk premium, the ERP, in the U.S. market.
Explain that a bit.
It's basically the extra return investors demand for holding stocks compared to something risk-free, like a government bond.
Okay.
And its decline to historically compressed levels, That suggests investors still have a really high appetite for U.S. stocks.
So high they're not demanding much extra compensation for the risk.
Precisely, which often points to prices maybe deviating from the underlying fundamentals.
And we saw a pretty stark example of what that can mean back in January 2025, didn't we? Even before the big tariff announcements.
The DeepSeek AI story.
Yeah, on January 27th, this Chinese company, DeepSeek, announced a potentially lower-cost AI large language model.
And that instantly triggered a correction in tech stocks. The S&P 500 IT sector fell over 5%, dragging the whole index down.
It was such a clear reminder, wasn't it, how much equity valuations depended on continued really strong earnings growth.
Definitely.
But, I mean, given that reliance on earnings growth, does that suggest the market hasn't really learned from past tech bubbles? Or is something fundamentally different this time that justifies those levels?
It's a really valid question. I mean, the market's enthusiasm for AI is certainly a huge factor. The expectation of future earnings from these technologies is sky high. However, events like DeepSeek show just how quickly that sentiment can shift if the competition heats up or that growth path is challenged.
And then the April 2nd tariffs just poured fuel on the fire.
Exactly. Accelerated that sell-off worldwide, triggering fears of, well, stagflation in the U.S. and potential recessions elsewhere.
And we saw corporate bond spreads widen, too.
Yes, reflecting those investor concerns over how tariffs would hit corporate earnings. And U.S. valuations in corporate bonds also remain stretched, suggesting, further widening is quite likely as these economic headwinds keep blowing.
Okay, so we've covered the risks of asset price corrections. But what about the entities actually facilitating a lot of these investments? The non-bank financial intermediaries, the NBFIs, are they building up dangerous leverage themselves?
That brings us neatly to the second core vulnerability, potential strains on these highly leveraged NBFIs.
So we're talking hedge funds, mutual funds, private credit.
Exactly. And they've grown faster than traditional banks, grabbing a much larger share of global financial system assets.
And that growth comes with more leverage.
It does, growing aggregate leverage levels and, crucially, deep interconnections with the banking sector.
How deep were we talking?
Well, what's concerning is the sheer extent of bank exposure. U.S. banks' loans and commitments to NBFIs surged from about 6% of total loans back in 2010 to roughly 16% by Q3 2024. And get this, that's almost 120% of bank regulatory capital.
Wow, 120% of their capital. That's huge exposure.
It is. Hedge funds, for instance, rely on banks for more than half of their total funding, and they've rapidly increased that borrowing.
And their own leverage.
Their aggregate gross notional exposure to assets has more than doubled over the past decade. Some strategies, like macro and relative value fixed income, show incredible leverage 40x, 25x their asset values.
40 times. Good grief.
And interest rate derivatives alone make up almost half of their total gross notional exposure.
This just sounds incredibly precarious. I mean, if NBFIs are so deeply intertwined with banks and so leveraged, what's the biggest trigger that could cause them to, hit a wall? And how fast could that spread?
I think the most immediate trigger would likely be a sharp, unexpected market shock. Maybe another big tariff move or a major earnings disappointment, something that forces a rapid repricing of assets.
And then what happens?
When NBFIs face margin calls and liquidity needs, especially if they're weakly managed or super leveraged, they're forced to deleverage rapidly. That means selling assets.
Which can start a downward spiral.
Exactly. It can trigger a rapid sell-off spiral, making market turmoil much worse, with serious implications for the whole financial system. We saw this dynamic play out back in March 2020. Remember the dash for cash?
Oh, yeah. Even safe assets were getting hammered.
Precisely.
And it's not just hedge funds we need to worry about here, is it? What about private credit?
No, exactly. Private credit funds also lean heavily on bank credit lines. Identified bank exposures globally are over $500 billion there.
And there are concerns about their valuations.
Yeah, a major concern among market participants is that the deterioration in the credit quality of the borrowers these funds lend to, well, it hasn't been fully reflected in the accounting valuations.
Why not?
Because many are using payment in kind, or PIK, provisions.
Meaning they're not paying interest with cash.
Right. They're adding the interest payment to the loan principal instead. It gives the borrower breathing room now, but it can mask underlying financial problems and delay recognizing just how bad the credit situation might be.
Okay, so we've explored these broad fault lines, overvalued assets, hidden risks in non-bank lending. But now let's zoom in a bit. How are these playing out in specific corners of the world or certain sectors?
Good idea. That brings us to the third core vulnerability.
Oh.
The brewing turbulence in sovereign bond markets.
Government's own debt. Where's the main vulnerability?
Jurisdictions with high government debt levels are particularly vulnerable. Think about emerging market economies.
They're facing high borrowing costs already, right?
Exactly. The highest real financing costs in a decade. Now, with tariffs hitting their economies, they might need to issue even more debt at these high rates just to fund essential spending.
That sounds like a potential debt trap.
It could become one. And it's not just emerging markets either. Major advanced economies will also likely issue more bonds to finance their own growing fiscal deficits.
At a time when the bond market itself is maybe a bit creaky.
That's the problem. Bond market functioning is already challenged. It's particularly striking in the U.S. Treasury market. It's just outgrown the dealers' balance sheets.
How much?
The market is now 5 times the size of dealer balance sheets. 20 years ago, it was only 1.5 times.
Wow. So the intermediaries are relatively smaller compared to the market size.
Precisely. Imagine trying to sell millions of concert tickets, but the brokers are much smaller than they used to be. It makes things like repo REITs much more sensitive to treasury issuance.
And increases the risk of liquidity drying up.
Exactly. It gets harder and more expensive to buy or sell large amounts quickly without moving prices significantly. That's a real bottleneck for the whole system.
And we're even seeing signs of stress in the euro area, like with German bonds.
We are. A negative basis spread has opened up between interest rate swaps and similar maturity German government bonds, the bunds.
That's unusual, right?
Yeah.
The government bond yielding less than the swap.
It is unusual. It basically signals deep market concerns about who is going to absorb all this new German debt without yields rising significantly, especially with the ECB doing quantitative tightening, pulling back its own bond buying.
Okay, let's pivot now to some of those sector-specific vulnerabilities. They really paint a granular picture of where the cracks are forming.
Agreed. Let's start with emerging and frontier markets.
What's the picture there?
Well, foreign investor demand for EM assets has been pretty tepid. We've seen persistent outflows from EM bond funds.
So, money flowing out.
Yes. And the risk of capital outflows is significant, potentially reaching 1.6% of GDP over the next year with a 5% probability.
And that could get worse.
It could worsen to 1.9% if the U.S. dollar strengthens and U.S. stocks sell off further. That creates a really nasty negative feedback loop for them.
And those high real interest rates aren't helping.
Not at all. Still around their highest levels in a decade, putting huge pressure on their debt burdens.
What about the frontier economies, the smaller, riskier ones?
Well, conditions had actually improved for them a bit before the April tariffs hit, but that recent turmoil pushed the share of frontier sovereigns with bond yields above 10% to almost 30% in April.
30% paying over 10% yield. That makes refinancing incredibly difficult.
Hugely difficult. It really exacerbates the refinancing risks. A big red flag for anyone looking at sovereign debt exposure there.
Okay, let's turn to China. It always seems to have its own unique set of challenges.
It certainly does. Right now, investors are concerned about a weakening growth outlook and deflationary pressures.
And that's showing up in their bond yields.
Yes, China's government bond yields have kept declining since October 2024. And 1 year ahead, inflation expectations have actually dropped below 1%.
Below 1%. That signals real deflationary headwinds.
It does, and it's led to the term premium on their 10-year government bonds dropping to a record low.
Why is that happening?
It seems linked to shifts in institutional investment behavior. What's worrying is that weak credit demand and a tough profit outlook have pushed Chinese banks, especially the smaller ones, to pile into government bonds.
Creating concentrated holdings.
Exactly. And those smaller banks could face disproportionate pressure if these tariffs trigger a material growth slowdown in China, potentially a domino effect within their banking system.
And it's not just banks feeling the pressure.
No, Chinese life insurers are also feeling the heat. They're squeezed by lower investment yields, particularly on their bond holdings, and their solvency ratios are declining, which is hitting their valuations too.
Okay, let's move to commercial real estate, CRE. We hear a lot about that. What's the latest picture?
Well, we are seeing some signs of stabilization, but honestly, don't let that fool you. There are still deep headwinds.
So prices aren't collapsing everywhere.
Global CRE prices and transaction volumes have stabilized somewhat. Total returns were actually positive in Q4 2024. But, and this is key, the recovery is very uneven.
Meaning some sectors are doing much worse than others.
Precisely. The office sector, especially in North America, has seen really significant value declines. We're talking 12.3% year over year and over 20% down from its peak.
Largely due to remote work shifts.
Exactly. Structural shifts towards less in-office work. That's a huge change.
But the thing that really jumps out is this looming refinancing wall we hear about. Can you just paint a picture of how massive that really is? Why is it such a concern?
It's truly massive. Estimates suggest $660 billion in U.S. commercial and multifamily real estate mortgages are due for payoff in 2025 alone.
$660 billion in 1 year.
Yep. And looking further out, a staggering $3.2 trillion in CRE debt matures between 2025 and 2029.
$3.2 trillion. That's a monumental amount of debt that needs to be repaid or refinanced.
It is, and the refinancing success rate is troubling. Only 61% of U.S. CMBS loans, that's commercial mortgage-backed securities, that matured in 2024 were actually paid off.
How does that compare historically?
That's down from 78% over the previous decade. And for office property specifically, it's even worse. Only 32% of those conduit loans were able to be refinanced in 2024.
So a lot of loans aren't getting refinanced or paid off.
Correct, and consequently, CRE delinquencies have continued to pick up, with office-secured loans being the primary driver of concern. That poses real risks, especially to regional banks that are heavily exposed to this sector.
Okay, finally, let's look at households. What vulnerabilities are showing up there, especially around equity exposure and debt?
Globally, households are holding a larger share of their financial assets and equities than ever before.
Really? More than ever?
Yes, U.S. households' stock holdings actually reached a record high by the end of 2024.
Which, of course, makes them more vulnerable if the stock market corrects, like we saw with that DeepSeek AI story.
Exactly. For individual investors, it just means being aware your portfolio might be more sensitive to market swings than it has been historically.
What about debt? Are rising interest rates biting?
Well, higher rates have only modestly increased U.S. household debt service ratios overall, but we are seeing delinquency rates increase notably for variable rate auto loans and credit card debt over the past couple of years.
So pockets of stress are emerging.
Definitely. What's particularly intriguing here, though, is the housing market, specifically the lock-in effect.
Ah, yes, the lock-in effect. Explain that.
Despite higher interest rates, U.S. home prices remain elevated. Why? Because homeowners with low existing mortgage rates are discouraged from selling their homes. They don't want to take on a new, much higher mortgage rate.
Right, so they stay put.
They stay put. And that's compounded by a persistent lack of single-family housing supply.
That lock-in effect is so relatable. It's almost like everyone's tied to their current mortgage rate with golden handcuffs.
Haha, that's a good way to put it.
But seriously, how does that dynamic in the U.S. compare to places like Canada or France? You mentioned prices are actually declining there, despite them also having fixed-rate mortgages sometimes. What's the key difference?
That's a great point. The lock-in effect is much stronger in the U.S. because of the prevalence of very long-term, like 30-year fixed-rate mortgages.
What?
In countries like Canada or even France, variable rate or shorter-term fixed-rate mortgages are more common. So homeowners there feel the direct impact of higher interest rates much sooner through higher monthly payments.
Which gives them more incentive to sell or forces prices down.
Exactly. That direct financial pressure incentivizes selling or leads to price adjustments. Whereas in the U.S., many homeowners are just choosing to stay put with their lower rates. It effectively reduces housing supply and pops up prices, even though affordability is a huge challenge for new buyers.
So with all these interconnected vulnerabilities, stretched assets, NBFI leverage, sovereign debt issues, CRE pressures, household dynamics, what does this all mean for policymakers? How do we navigate this storm?
Well, the IMF report lays out a pretty comprehensive set of policy recommendations.
What's top of the list?
Firstly, crisis preparedness is absolutely key. Authorities need to be ready for financial instability.
Wow.
By ensuring financial institutions can actually access central bank liquidity facilities if needed, and being ready to intervene early if severe liquidity stress or market functioning issues pop up, especially in those core bond and funding markets.
So having the tools ready before things break.
Precisely.
And monetary policy, that's got to be tricky.
Incredibly tricky. Central banks need to carefully gauge price movements. They might need to ease gradually where growth and inflation are clearly slowing.
But stay restrictive elsewhere.
But maintain a restrictive stance where inflation remains stubbornly high. It's a very delicate balancing act trying to avoid both recession and persistent inflation.
What about those NBFIs we talked about? The non-banks.
Yeah, it's absolutely crucial there to strengthen policies that mitigate the vulnerabilities coming from their leverage.
Like more oversight.
Yes, enhance reporting requirements for NBFIs to get more transparency, and foster closer coordination among different authorities for comprehensive monitoring, really trying to get a better handle on these less regulated but highly impactful players.
And for the traditional banking sector.
Resilience is key. Full, timely, and consistent implementation of Basel III standards and other international rules is needed.
Why?
To address unwarranted differences in how banks calculate risk weights, for one. Supervisors also need to keep stress testing banks' exposures, especially to CRE, and get better at assessing the risks from those bank NBFI linkages.
Making sure banks are strong enough to withstand shocks from the non-bank world.
Exactly. The goal is robustness.
What about government budgets? Fiscal policy.
From a fiscal perspective, countries really need to focus on credible, growth-friendly plans to rebuild their fiscal buffers.
Paying down debt, essentially.
Or at least getting deficits under control. It's imperative to ensure debt remains affordable, and they can still access external financing without causing investor panic or an abrupt tightening of financial conditions, especially for those highly indebted nations.
And crypto assets, they're always part of the conversation now.
Yes, the report touches on that too. Jurisdictions should safeguard their monetary sovereignty, strengthen their monetary policy frameworks.
Guard against volatile capital flows related to crypto.
Exactly. And adopt clear tax treatment for these assets. The message seems to be, regulate them, yes, but do it thoughtfully.
Finally, does this all require more global cooperation?
Absolutely vital. Enhancing multilateral surveillance is critical to monitor and prepare for global shocks, cross-country contagion, and those economic and financial spillovers we've been talking about.
And strengthening the global financial safety net.
Also essential. Recognizing that financial stability isn't just a national issue anymore, it's really a shared global responsibility.
Wow. We've navigated a really complex landscape today. From the unexpected impact of tariffs and that broad economic uncertainty.
To the hidden leverage in non-bank financial institutions and those brewing storms in commercial real estate.
What's profoundly clear, I think, is the deep interconnectedness of all these vulnerabilities.
Definitely. A shock in one area can ripple through the entire global financial system incredibly quickly.
Impacting everything from, your investment portfolio to the stability of maybe your local regional bank.
It's all linked.
So as we wrap up, let's think ahead. We increasingly see the rise of digital assets, the transformative power of AI, like that DeepSeek announcement, highlighting rapid tech shifts. It makes you ask a provocative question, doesn't it? How might future financial crises actually manifest differently given these technological shifts?
That's a fascinating thought. Are our existing policy toolkits even equipped for what might come?
Right. Are they ready for unprecedented forms of, say, deleveraging spirals or maybe lock-in effects, but in entirely new digital markets?
Or are we on the cusp of challenges that will demand entirely novel solutions we haven't even conceived of yet?
Exactly. This is really just the beginning of that conversation, I think. Definitely something worth mulling over.